Hi, everyone. Welcome to our panel. We're going to get started in a minute. My name is Rachel Wolfson. I'm a journalist and podcast host. I write for cryptonews.com, Cointelegraph, and I'm the host and founder of Web3 Deep Dive Podcast. Today, we are speaking about derivative solutions for Bitcoin miners. Really interesting topic, very timely as well. And before we get started with the questions, I'm just going to go ahead and let our panelists introduce themselves briefly. Also, I think you guys have headphones, so if you have trouble hearing, if you put the headphones on, I believe that can help. So just a reminder there. Cool. Okay, Aaron, do you want to start with an introduction?
Yeah, my name's Aaron Foster. I'm a Director of Business Development with Luxor Technology. So Luxor Technology is a software company providing mining solutions for miners through our various products, in addition to financial instruments. One of those that we're most known for today are Luxor derivatives, so hedging and financing tools for miners. So pleasure to be here talking about the wild and exciting world of derivatives and hash rates. So.
My name is Ryan Condron. I'm the CEO of a company called Titan.io. We do private mining pools for large miners, more dedicated specialized software. We launched a decentralized routing system called Loomeran last year, actually, where you could buy and sell decentralized hash power essentially through smart contracts. And then we architected a decentralized AI compute network that actually went live a couple days ago called Morpheus.
Great. Okay. So let's discuss the problems that miners have today and explain why free market tools in the form of derivatives products can help offload risk. So Aaron, do you want to get us started? Maybe explain what the problems are and why these solutions could be helpful.
Sure. At the heart of it all is when you look at what hash rate is and what miners are producing as hash rate. The way that we view it at Luxor is hash rate is effectively a commodity, no different than an oil producer, oil, natural gas producer producing gas. When you look at those kind of traditional commodity markets, there's, more evolved markets, obviously, but they have tools to kind of hedge some of those inputs and outputs as part of their operations. This is where Luxor's kind of stepped in and provided some solutions as a result of that. But at the heart of it all comes down to like hash rate being a commodity and a tradable commodity at that. And that's some of the things that Ryan's working on the decentralized front. So I'll kind of maybe just jump in to kind of as to some of the stuff that Luxor has to kind of maybe focus on that first, just to kind of hit home a bit more with the crowd here. But we have about 3 different kind of products to kind of leverage those kind of traditional hedging instruments or financial instruments. One of those being what we call an NDF, non-deliverable forward contract. And how miners can think of that is basically an insurance product to take a position on hash price. We also have a forward selling product, so miners can effectively leverage that hash rate to forward sell into the market and receive Bitcoin up front for some of that. So you can kind of think of it as like a financing tool. And these are all kind of like common tools that you find in traditional commodity markets for miners either to hedge their exposure to the commodity itself or use it to leverage to finance as well. And then we also have through Bitnomial futures product as well. So I'll kind of set that stage and kind of go from there. So I don't want to overwhelm people too much. But
with Loomeran, we provide kind of a decentralized market. So it's completely anonymous, completely decentralized. Buyers and sellers have an engagement on chain at will, and it's a completely deliverable product at this point. So you post hash power in a contract. Anyone anywhere in the world can use a Web3 token to purchase that contract, and the proxy router that runs inside the mining facility reroutes the hash power to fulfill the order in real time. So it's a real-time deliverable commodity. So we've spent several years building that, fine-tuning it, and that's what Loomeran put live last year. To answer the question more directly, as far as why would anyone want to do that, there's a lot of risk and there's a lot of operational expense in mining. So every single 2 weeks, we have this thing called a difficulty adjustment where the whole economic calculations completely change on what our profitability is. And we are betting as miners every 2 weeks that we are still going to be profitable and people are not able to turn on enough hash rate to drive the the difficulty so far up that we are no longer profitable. So we are literally in a race to find the world's cheapest electricity as fast as possible to get miners on board before the difficulty adjusts and we're no longer profitable. And we're no longer profitable again, then we have to retool, find better chips, cheaper electricity. And this is just the cycle that we've been going on for over a decade now. That's a lot of risk, especially when you're deploying millions and millions of dollars. Why a derivative product on this commodity is so important is you can actually hedge that risk. You can allow someone else to take the other side of the market. So we're doing it in a decentralized fashion. Luxor is doing it in a more centralized fashion. But it's very much the next stage in this market for the market to evolve and become more mature is the financialization of hash power and treating it as a true commodity rather than just a hobby at this point.
Yeah. Can we talk a little bit about the financialization of hash power? Is there this large need for it now? And let's talk about the real world solutions that are being implemented and how are they being implemented? I know you guys touched on your solutions briefly, but how are these actually being applied today? And is the need for them greater now? Eric?
Sure. Yeah, I can take that. As Ryan kind of alluded to, obviously a large capital expenditure to start a mining operation, hundreds of millions of dollars depending on the size, or hundreds of thousands depending on on the retail side. Where you kind of see a lot of interest is more on the institutional side, where they don't necessarily want to allocate the capital to kind of the physical hardware. It's more on the physical hash rate side. So they want to be buyers of hash rate. They want to get exposure to hash rate. So they kind of step in and say, how can I access this and that synthetically? And that's where kind of like that physical forward instrument that we created kind of evolves from. We had a lot of interest in users wanting to access hash rate and get Bitcoin for effectively cheaper at the end of the day than what the market was kind of bidding in. So we created that product to kind of service that more institutional side where folks wanted to deploy capital into the space through a regulated product without having the need to kind of go through the hoops and hurdles of setting up their own mining operation or on the more of the physical side. So it's more of a synthetic option, I guess, at the end of the day. So
yeah, I mean, if anyone's reading the news, if anyone's paying attention, there's this thing called AI, and it requires a lot of electricity. And anyone that knows anything about data centers and the high performance compute knows that it's not a flexible load. When it's needed, right? It's not like Bitcoin mining. That is the flexible load. You will not have scalable AI compute without Bitcoin mining to counterbalance it, right? Anywhere in the world you have these massive data centers coming online, we're going to have massive amounts of generation coming online, massive amounts of AI compute, and it has to be paired with flexible load. Right now, Bitcoin is the only thing on the face of the earth that can handle that flexible load and actually provide a monetized customer in the form of the Bitcoin network 100% of the time. You can throw as much electricity at the Bitcoin network as you want, and it will always take it, and it will always pay you for it. And that's amazing, right? But now we have AI coming on that's going to be a contender for that electricity. And where we've positioned ourselves, without even realizing it, Bitcoin miners over the past decade have positioned themselves to corner the market on the most valuable resource on the planet, and that's electricity. Bitcoin miners have spent the last decade scouring the earth for cheap electricity, signing the power contracts, building the infrastructure, and now not only they're in the right place at the right time with the right products, and we are about to capitalize on one of the largest booms this world has ever seen for economic growth, innovation, and just a crazy shift in this golden age. Like, it is going to be absolutely insane. And when you just consider that it's all going to revolve on electricity, right? We've had electricity markets for ages, but electricity is being split into two commodities, hash power and AI compute. And we're going to need markets for both of those that are not just these confined analog localized markets, but they are going to be global, they are going to be fast, and every single nation state on the face of the planet is going to play in these markets. So that's why derivatives are so important, because anytime you launch a new market, you're going to have people that want to throw billions of dollars to gamble on that market, and we need to start prepping for that now.
Ryan, do you have any use cases that you want to share with us that Titan has maybe implemented today?
That's a dangerous question. Yeah, I'm a big fan of the Morpheus network. I mean, I'm literally wearing a T-shirt right now. We deployed this network just a couple days ago for AI compute, where we literally have a node that can connect any compute provider with any user or use case around the world. We built the entire transmission structure and monetization system, and that went live like 2 days ago. And now it's just a matter of bringing on these providers, bringing on these users. We have Venice.ai is currently testing it. They have over 100,000 users going head-to-head with ChatGPT. They're ready to come on board. And the whole mantra behind all of this is freedom of access to both the compute and the hash power, and key point, privacy and anonymity. So many of these systems that are coming online with these supercomputers, ChatGPT, Google, Grok, whatever, you are the product. They're using your data to train these models, and they will keep growing on them. But, I'm a Bitcoin, through and through, a Bitcoin person through and through. I believe in freedom of access. I believe in freedom of information, but I also believe in being able to protect myself, to own my own data, be able to encrypt my own data, and not let every single bit of prompt that I send to an AI engine get sniffed by the NSA and they get trained to the next model. If I'm going to take a PDF of some contract that I want to review, I don't want that getting loaded into ChatGPT and then trained into the next model. So, having privacy in AI, privacy in compute, that's why I think Morpheus is so powerful. And I'm really excited to be a part of that. And then obviously Loomeran with the hash power derivative side, but that's a deep rabbit hole. So
Cool. Okay. What are the biggest challenges in terms of getting these derivative products out to miners or people mining? I mean, it seems like these are needed now, but it also seems like, we discussed before this panel, I didn't know so much about this topic. It just seems like something that a lot of people may not be familiar with. So why is that the case, and how can we make them more familiar? Aaron, do you want to start?
I think when you look at our industry, and I come from a traditional energy background prior to joining Luxor 3 years ago, there's a lot of education involved. Our industry is very new. We're still, up until basically 3 years ago, a lot of even miners didn't even hedge their power contracts and their inputs at a large scale. So a lot of my time and the team's time is actually spent educating what is derivatives, this spooky word of derivatives, and we joked about it earlier, but it comes down to education, time in the market. A lot of these teams that we are working with effectively don't have their own teams internally to a power trading desk at the forefront of it, but they just don't have the sophistication yet to utilize some of these products that we've created. So, and this is on a kind of more centralized approach or institutional level. Ryan on the DeFi, that's a whole other level of understanding that folks have to understand, but it's really just a slow kind of growth curve. I mean, from a product perspective, we see month over month growth of the actual product itself, but that's kind of sales cycle lead time has been months, if not years, to kind of get those folks and teams up to speeds. And you'd be surprised at how unsophisticated our industry is in general, but that's getting better. I mean, a lot of people are joining, including myself, or people from other traditional backgrounds that have joined and are bringing some of that knowledge and experience and saying, hey, why aren't our energy contracts hedged? Why aren't the outputs or hash rate hedged as well? And why don't we have and create some certainty? And there's obviously some benefits to doing that, whether it's on the financing side or debt side and whatnot. So I'll pause there. But
yeah, I think and getting miners to move into something new is very, very difficult. And Aaron was saying, as far as a slow sales cycle, it's like, I mean, slow. It's a lot of miners, they take so much risk with their upfront capital. And they buy the hardware, they buy the infrastructure, they get everything online, and it's just about paying the power bill and getting by from difficulty adjustment to difficulty adjustment, and trying to introduce a new product, even trying to get them to switch mining pools, honestly, is like pulling teeth. I can point out to miners and say, look, it takes 4 people or entities in this world to collude, and you basically have 99% censorship on the Bitcoin network. Because if you look at the layout of mining pools, it's essentially 4 pools run all the hash power. They do all the block creation. And if you really boil it down, it's actually really 2 entities. It's Ant Pool and Foundry do over 75% of the block creation, right? If I had those 2 entities put together a whitelist, now you have over 75% of the block creation is censored, okay? Even knowing those stats, everyone sees it. Do you think any of them are running their own pools? Do you think any of them are actually like spreading out their hash power to multiple pools or mining against Luxor? Like, no, because the risk, right? They put so much risk in the infrastructure. They don't want risk other places. And then you start showing them derivative products. And you say, hey, you could hedge your hash power. You could sell it out 6 months from now. And you can, take a different position to try to ease things. There's a lot of miners that are slowly getting there. But miners are like the most paranoid people in the world and the most trusting people in the world all at the same time, where they'll send their hash power to a pool without even knowing who it is, and yet they won't even work with a local commodities product. So I started mining in 2012. I ran about 80 different mining pools in 2013, 14, 15. I've seen the gamut of it. I've seen the cowboy miners, and I've seen the Wall Street miners, and they all have their different plays. But at the end of the day, we're a profit-driven animal. We are literally there to plug in a toaster and print money. And no one really wants to recognize it for that, but that's what we're doing, is we're plugging in toasters and printing money, and we're trying to keep that toaster online as long as possible. And then when I try to introduce a new product on top of that, it's very paranoid. It takes a lot of education, and the sales cycle is just terrible.
So my question is this: if we see more regulations that are friendly towards Bitcoin miners, and I think in Texas, we're already definitely seeing that. We've got a lot of, like Senator Ted Cruz highly supports the Bitcoin mining industry here. When we see more support for Bitcoin mining, do you think these products are going to have to start gaining traction?
The best support you can do for Bitcoin mining is no regulation. Like, stay out of it, and then find ways to make electricity cheaper and more accessible. Right, that's the very best thing you can do for Bitcoin mining. But as Bitcoin mining scales, it is core infrastructure, and government gets involved in core infrastructure. So I was telling someone this earlier. There's only time before the Department of Energy gets involved in a national mining pool or a very large mining pool. I firmly believe that within 5 years, just about every single nation state that wants to balance their grid with flexible load will be partnered with a mining pool in order to do so. It's the flight path for all of it. So better regulation. Yeah, I would stray away from regulation and just regulate around power and open up more nuclear options and lower the cost of power. And that's going to be a boom for any grid.
Do you want to add any comments, sir?
I kind of take the opposite approach. Like regulation within being reasonable. I mean, you can go too far. The nuclear industry in general got regulated way too far. Now we're kind of swung back the other way. We come from the nuclear world, so seeing the renaissance now in real time. But when you add in, I think regulation helps mainly from what we see is with counterparty risk. We obviously went through that in the last bear market with the class of FTX and some other large institutions in the space. But with regulation kind of comes standards at a good level when you're dealing with some of the largest funds in the world. So when you look at it from that perspective, that's actually kind of a good thing, depending on how far it goes. I mean, in moderation, I guess, to a certain degree. When some of those regulations require standards and risk measures when it comes to your counterparties, that also keeps folks like us in check and want to, when we're kind of using that product. I think the easiest example of that is if you have a financier lending you, whether it's Bitcoin or cash, to go purchase ASICs, why not, as part of that contract, have to hedge your exposure to something like hash rate so that you can kind of, from a lending side, have actually a certainty of revenue that borrower is actually going to pay you back at the end of it. Insurance products. Why not have, if you're insuring that asset, hundreds of millions of dollars in ASICs as an example, why not have that client hedge exposure to the commodity that they're producing? It's all about certainty and it's all about predictability, so we don't go through these volatile 2, 4, 5-year cycles. So that's where I see it. I kind of come out from the other side, but
Okay, go ahead, Ryan.
I honestly think if we try to regulate out the 4-year cycles, we will literally hamstring America. Like people will just move offshore. Like every other nation state on the planet will have a lead on us if we try to regulate out the cycles. I just, anyways, sorry.
No worries. No.
I could just, yeah, that's a whole different aside.
centralized.
Yeah, exactly. I mean, I'm an engineer. I don't think like capital markets. I think like, how do I provide freedom and anonymity and access to people? I don't think, how do I keep people safe? I think markets will naturally keep people safe and it will weed out stupid people. And I'm sorry, like if that's offensive, but people make dumb decisions all day long and they will put themselves at risk to get the reward. The difference is, we don't call them stupid if they make a risk and it pans out for them. I have a friend in 2011 that took out a second mortgage on his house and threw every penny he owned into Bitcoin, right? That worked out. He's one of the wealthiest people I know and everyone calls him a genius, right? If it went the opposite way, if he threw his money into some, random stock and it was a penny stock at the time and it went the opposite way, they'd call him the stupidest person, ever, right? History is made by the victors. And the reality is free market will weed these type of people out regardless of regulation. So yeah, I am on the decentralized side. I really think that the more free we make it, the more encrypted, the more anonymous, and the safe from a protocol level where people can't rug pull, that's where this type of technology will flourish.
Cool. Thank you. Let's talk about if the rising price of Bitcoin, which is close to 100K today, I don't think we're there yet, is that going to impact these products at all? Ryan?
I'm talking. Here you go.
Absolutely. I mean, we're always, you can kind of see it from our news feeds where the derivative teams is always pinging folks, reminding folks and our clients saying, now is the time to hedge. 2 years ago, I'm getting my time frames mixed up, but $120 a petahash back in the last bull market, $100 terahash ASICs. I paid $85 myself. And I'm, we're all stung by that. That is the time to hedge. Whether that's 100%, 10%, 30%, that's when you should be thinking about that, whether that's today, 6 months from now, but these tools didn't exist 2 years ago. And here we are, hopefully on the precipice of another crazy bull run. I'm not sure if I'm personally ready for my third cycle, but here we are. So during the, over the past 3 years, we basically built this out to hopefully minimize that downside risk that a lot of our industry faces in these big run-ups like what we're seeing today in hash price and Bitcoin price.
So one of my good friends is a CEO of a coal mine, and he would trade in commodities markets, and he timed the coal market like so perfectly, and he sold everything. And I asked him, because so like 6 months later, whatever, it corrected, it went back down, and he just made a killing. And I asked him, like, how did you know to sell? Like, how on earth did you know to sell all the coal right then? And he said it was easy. He's like, someone random that he didn't even know started telling him about the amazing investment opportunities in coal. And this guy had, like, he wasn't in the coal industry at all, but he was telling him that coal was the investment to be in. He's like, if this dude, just random guy, knew that coal was being, it was time to get out, right? I was at my cousin's wedding, and I had a random guy, had no clue who I was, started talking to me, and he started telling me how I should buy Dogecoin. This was a couple years ago, right? This was literally at the peak. In 2021, I was at my cousin's wedding. He's telling me to buy Dogecoin, right? And I'm just like, I should probably sell all my Dogecoin right now if some random person's telling me now it's time to get into Dogecoin. So Aaron's exactly right. Whenever price goes up, you start seeing more and more people flock in. And when everyone says now's the time to buy, typically that's kind of an indicator of the top. And I'm not an oracle. I'm not going to say I'm going to call it or anything like that. I don't know. But I will say we do see the same cycle over and over and over every 4 years. And we know that the halvening happens, then there's a pause. Then there's 4 months later, we start seeing upswing in price. And the pause between the halvening and the upswing in price, there's a complete bloodbath in the mining industry because people are trying to hold on as long as possible. They don't want to sell. They're trying to hold on. We start seeing that relief. But now in this cycle, we're seeing a combination of institutional capital coming in, government capital coming in. Gensler literally just stepped down today. So, I mean, we are seeing so many high signs, right? And over the next 12 months, we are going to have some of the craziest movement in this market that we've ever seen. But then you're pairing that we are fighting with the AI industry over electricity. So it's literally like the perfect storm. So do you want to hedge right now? Maybe not right now, but in 6 months, it might be a pretty good idea because we're just going to go right through the same cycle over again. It's literally designed into the markets. So,
just to kind of add to derivatives and hedging and all these like trad fights. I always mad or head of derivatives about this. At the core of it is it's insurance, and we all have insurance, home insurance, life insurance, all the tools and instruments that we've created is effectively just insurance for the mining industry. And that's at the heart of it. That's really what it is. So when you look at it from that perspective, it's just like I'm buying insurance. I'm taking a position on hash price or hash rate in the event that it continues to decline. Like miners in general are naturally long Bitcoin. So why not say, hey, I need some revenue certainty. I'm going to take a position. And that way, 6 months from now, Luxor has 12-month contracts now. I know what my revenue certainty for X percent of my my business is. So that's why I like to dumb it down. But
yeah, Aaron, you also said something interesting. You said that these products were created, like 2 or 3 years ago is when they came to market?
For us, yeah.
Okay. So, I mean, today, are you seeing a greater need for them than you did 2 or 3 years ago?
Absolutely. I mean, the industry is maturing. And like I said, just on a product basis, we're seeing month over month growth. We just announced publicly today, we don't normally do that, but we just did roughly a $3 million deal with a miner that was looking to not only purchase ASICs, but also hedge that exposure. So like we're able to bucket and combine a lot of our products together to facilitate transactions and grow the industry and in general, right? So when you look at the instruments that we've created, I've mentioned before, is on the financing side and leveraging that hash rate to finance the ASICs. They also took some of that liquidity up front and actually used it to hedge their operations. You kind of we just posted that today. So if anybody's curious, come talk to me afterwards. But when you look at all of those different pieces of the puzzle, as you kind of start mining, that becomes a key part of it in our opinion.
So synthetic projects on top of hash power have existed for quite a long time now. So 2013, a little company called Genesis Mining was founded. Marco did an incredible job. They launched the cloud mining idea, right? A month later, my buddy and I launched the same thing, but for script called GigaScript. Genesis had way more capital than us and obviously scaled way better, because you've never heard of the one I started. But what I found out then was we had script hash power coming online when the ASICs first came out in 2013. And we started selling in early 2014 the cloud hashing contracts, okay? Which is no different than what we have today in the form of derivatives contracts. It's just we're forward selling hash power for 24 months for a certain amount of money up front. And people could trade that and settle it or whatever. Now, the crazy thing was, at the time, per mega hash for script mining was going for a couple $100. The way we built our system, not the smartest, but it was the fastest, we didn't have a way of turning off the sales, but we could just adjust the price. So when we ran out of cloud hashing contracts, we just raised the price and thought no one's going to buy, right? And it was supposed to be a couple $100. We raised it to $1,000. We're going to stop the sales. Guess what happened? People kept buying, right? They were speculating. They were buying a 24-month contract for a cloud hashing contract. We thought, okay, $1,000. Okay, we need people to stop buying. We raised it to $10,000. $10,000 a mega hash. There's no way anyone would ROI on this. People kept buying, right? Now, mind you, this was early 2014. Our payment processor was none other than PayPal, right? Now, PayPal hadn't really banned crypto companies yet because we were still very, very early. So they called us when they saw so much money hitting our account in 48 hours. They're like, what on earth are you guys selling? We're like, oh, we're selling compute power. And they're like, okay, well, send us the invoices to show that you actually have the computers and we'll greenlight you. So we were actually the first company to be greenlit to sell Bitcoin hash power through PayPal in early 2014 because they didn't have a ban on crypto stuff yet. But people kept buying even that we're at $10,000, right? And that's what I realized is people will always gamble on crypto through synthetic products. They don't even run the ROIs. Now, we've gotten way more sophisticated now, and now we're calling them derivative products, and now we're calling them like hash rate futures, and we're calling them all these things. It's just a different attestation of the same exact thing. We're selling something into the future. We're selling a synthetic product. And we're going to keep iterating on it. Right now, we have more of a Wall Street friendly version. And we'll just keep iterating on it until there's the options and the futures and there's the real-time spot markets on hash power. And it's all coming. But it's as the industry matures, it's less and less cowboy, more and more Wall Street. And that's when regulation does come in. But that's why we need a decentralized version of it too, because I kind of like the Wild West version. That's just me personally. But yeah, we'll have both sides of it. Sorry.
Cool. Thanks, everyone. Thanks, Aaron. Thanks, Ryan.